All right, everybody. Stocks by the numbers. Welcome back. Today is Wednesday. We got a little less than 2 hours to go before the close. I wanted to do another one of my earnings videos. However, in my opinion, it seemed like there really weren't a lot of big names coming out today after market close. I know we have a couple of names tomorrow, including Costco. In my opinion, that's definitely one to watch. Going to show you how strong consumer spending is, in my opinion. And I wanted to take a look here at this company, Victoria's Secret, which is reporting earnings today after market close. Ticker symbol VSCO, listed here on the New York Stock Exchange. Now, obviously, this is a lingerie company. I'm sure you guys heard of Victoria's Secret. They were recently in the news. The business has been taking a hit. You know what they say? Go woke, go broke. That's the new motto here. And apparently, Victoria's Secret is really starting to take it on the chin here. And VSCO stock right now a touch over $25 a share, down over 1.5 points here, almost 6% drop here on the day, with earnings still due in less than 2 hours today after market close. So let's find out what's going on. So this company has really been under pressure, even though for some reason the stock is actually trailing upward here, especially since the random rally that took place since beginning of November around Halloween. So first of all, looking at the chart, in my opinion, just to speed it up, I'm looking for a pullback like here, back here where we double gapped up, and of course we have like this M top, but we've been climbing when the company has been struggling in the last couple of quarters. So that's why, in my opinion, I'm looking for this right here. Pull back to about 22.5, fill this gap. And obviously, you know, we're talking 10 to 15% drop here, and it could potentially accelerate afterwards and drop it to sub 20 into the high teens here, potentially about 18.75. But let's see what's going on. So looking at the numbers here, right? We've been up since December when these numbers came out. We look at these numbers, they were dismal, right? Revenue is now down compared to where it used to be. And if we look at last quarter, we can see the company technically missed earnings. Now, it wasn't by a big chunk, but technically they did miss. Losses much wider than expected, almost 10% above analyst expectations. The quarter before, basically same thing. Light on the revenue side as well. Again, not a huge miss, but it was less than 1%. You know, we're talking $10-11 million here. And of course, on the EPS side, another miss by about 8.5%, coming in below analyst expectations. We go to the quarter before, boom, same exact situation. Revenue sitting there at 1.4 billion on estimates of 1.42 billion, and the company misses on revenue again. This is now 3 quarters in a row that we just went back. Not only did they miss on the revenue side, but they missed on the EPS side as well. And when these earnings came out, the stock was 20. After the news hit, you can see the stock dropped to 17.39. We had our sell-off after the summer rally. And in my opinion, the stock should be somewhere down here. And you can see that we went from lows of $13.66 and beelined all the way back up to $30. Mind you, this entire time we were missing earnings and actually losing sales and losing business. Okay, so now we have a market cap of 1.94 billion, which immediately in the numbers could potentially be viewed as undervalued. However, again, they've been missing earnings, and a lot of these numbers have been decreasing quarter over quarter, year over year. We have a PE of, we'll call it 22.5. Company's earning about $1.25 per share. On the EPS side, again, you can see the profitability completely falls off a cliff here, going from $2.47 a share down to 28 cents a share the following quarter, and then consistently dropping and going negative last quarter. So in my opinion, this looks terrible. Not only did the margins really fall off a cliff, but more importantly, you're coming in lower than analysts expected for 3 quarters in a row. So if, in my opinion, if I was a betting man, I would absolutely go for puts on VSCO. And honestly, if you wanted to even straddle just in case, you could probably buy like 30 or 32 calls for probably pretty cheap, especially with the stock down almost 6% today. So this is what's difficult when we're dealing with earnings, right? Because a situation like this, if we're considering puts, you have to remember with the stock being down almost 6%, all of the puts that we are potentially about to buy going into these earnings are now worth more money, right? It's going to cost more because they're up, because the stock is down. So sometimes I used to play like the opposites, and a situation like this, even if I thought they would miss, again, this was with extra money, speculative cash that I could have afforded to lose at the time. So what I used to do is a situation like this, like, yeah, it sucks, and there's probably a good chance that they miss, which is why the stock is probably down almost 6%. But now with the stock down, as I said, the puts are worth more money, but the calls are cheaper. So I would, I would swim against the stream and I would buy like some cheap, like I said, like 30, 32 calls with a little bit of time. And then if it happened to actually surprise and pop after hours, you make even more return, obviously. But basically, what I'm looking at is a company that is seriously struggling. We can see now Q4 is coming in, right? This is Q4. You can see estimates back up above 2 billion here at 2.084 billion, estimating $2.46 a share. So the problem here is, again, in the immediate short term, Victoria's Secret could potentially beat these earnings. We could have a big pop and we could get back near the 30 plus range. However, as a longer term, broader view, in my opinion, this company really seems to be struggling. And if you're telling me that we may only have one good quarter out of the year, then in my opinion, I view that as a big struggle and a big negative. Because even if your Q4 is good, and again, I understand holiday sales coming in, you go out, you get something for your lady at Victoria's Secret, something sexy. I get it. But again, at the same time, almost like a GameStop, right? We spoke about GameStop and how I felt, in my opinion, that it was a struggling business just because there's no real proprietary service or product that they themselves bring to the table. So if you're showing me something like a GameStop and you're saying, oh yeah, but Q4 they always do well, it's like, yeah, they're making money during the holiday season, but the other 9 months of the year they're struggling and sales are dropping, and now they're losing money per share. It's just a story for disaster, obviously, but don't really need to go into it in detail. But we can see that the revenue has dropped down to the 1.4 billion mark. Last quarter dropping down to 1.27 billion. That's the lowest it's been going back the last 5 quarters. Q3 of 22, you can see 132 billion, brought in 24 million profit. Now we're at 127 billion. We lost 71 million. So technically, year over year, the company does seem to be dropping. And even looking at where we came from before lockdowns, you can see the company bringing in $7.5–8 billion a year here. No problem. Then we drop down to the fives here in 2020. We have our rebound to 6–7 billion. Then I believe the company started, quote unquote, going woke. And you can see that sales dipped a little bit going into 22 down to 634. But again, I feel like as of late, the company has really been feeling the repercussions of their actions. And again, you can see 3 misses in a row here. Before that, really not doing too bad, right? Nice beat on the top and bottom line. That was Q4. Before that, another miss on the revenue with a nice EPS beat. Another miss on the revenue with a nice EPS beat. Top and bottom line. Top and bottom line. Looking good. Looking good. So, as you can tell, as time went on, the stock has been dropping significantly. And in my opinion, it is justified. Because first of all, not only are people just starting to get pissed off in general, that's the vibe I'm getting, but again, to do something like this, I understand that these companies kind of feel that they're under pressure, that they have to conform, right? Oh, everyone else is doing this type of advertising campaign, we have to do one too. Everyone is reaching out and trying to speak to this demographic, we have to do that too. You understand what I'm saying? So no one wants to be left out of the loop. And if people want to talk about this group of people or that type of person, then every other company has to follow suit. And in my eyes, it's like they all got the same playbook. But obviously, for a company like Victoria's Secret, it is significantly backfiring. And some of these numbers are really getting out of hand, in my opinion. The debt has been slowly climbing over these last several quarters, as we see here going back to the second half of 22. You can see the debt, my pink, magenta, purple bar here, 276 billion, 279, 279, 285, 31. Now we're up to 31 billion, right? Company has a market cap of less than 2 billion. So now we have 150% of the market cap is debt. Now, granted, again, we could make the argument, well, it really got beaten up. Market cap maybe shouldn't be $2 billion. I understand that. But again, we're talking about a company that right now on paper is worth a couple of billion, and they're also holding even more than that. They're holding billions more in debt. So, in my opinion, that is a negative. We have assets technically outweighing liabilities, which isn't necessarily a negative. Switching over here to revenue, though, again, you can see, high 1.4s, here 1.5. We take the dip, boom, holiday sales come in, we break above 2 billion. Now we're in the low 4s, the low 1.4s, the low 1.4s. Now we're sub 1.3. So this is what I'm saying. Technically, year over year, looking at these quarter comparisons, the business does seem to be shrinking. Obviously, cost of goods went down because they did less revenue. Total revenue minus cost of goods sold yields gross profit. We can see gross profit is now the lowest it has been going back the last 7 or 8 quarters here at 428 million. Used to be about 100 million more than that. And obviously Q4 was a big quarter. This is what I mean. This is why it's hard to, in my opinion, it's very hard to call this one, because if they do beat, I would kind of understand because it's the holiday season. But if they miss, in my eyes, it's basically just continuing down the road it's been on, right? So obviously we could go either way, which is why I'm saying, again, in my opinion, if you wanted to be safe and you wanted to straddle this, understandable. In my opinion, based on what I'm personally seeing here, if I had cash on hand and wanted to play this, I would probably go with VSCO puts. Gross profit minus operating expenses yields operating income. We can see we were at tens of millions, over $250 million here Q4 last year. Then we dropped back down to about 60% less than where we were. And now, as of last quarter, operating income goes negative 66 million for the last 7-8 quarters. So this is why I'm saying a lot of these numbers really seem to be trending in the wrong direction. The total assets has climbed up here from the low 4s up to 4.7, back up to about 4.7. Liabilities, though, as you see, have chunked up significantly as well. And assets minus liabilities yields total equity, and we can see that the equity down here at 238 million is technically the lowest it's been going back the last 6 or 7 quarters here. 3 billion in debt. Book value was climbing to almost $5 a share and then completely fell off back down here at the sub 3 at 286. Technically not the lowest it has been. However, yeah, assets and liabilities are up basically the same amount, roughly that 600 million mark from this Q1 to this Q3, but not exactly sure if I would personally view that as a green flag. And we can see that we're trading at a pretty high price to book ratio. Free cash flow goes negative last quarter. Let's check some of the stats here. PE up here north of 22.5, we can see that the company historically, for the most part, was trading with a single-digit PE, which is why I'm saying if earnings have gone down, then the EPS goes down. So the PE ratio, which is the price to earnings ratio, is the stock price minus the earnings, the EPS. That's the PE ratio, right? But if earnings go down, then in proportion, the PE ratio has to go up, which is what we're seeing in the last 2 quarters. But now, if the PE ratio is viewed as too high because earnings have gone down, then in my eyes, it could inevitably take another hit, and we could pull back to the mid to low teens in the PE ratio. But again, we saw a lot of those numbers dropping year over year and quarter over quarter, so this could potentially be viewed as high, especially for an apparel company. Again, we looked at other stocks like Under Armour, I always bring up. A lot of these apparel companies could potentially be viewed as undervalued in the numbers. And right now, in my opinion, in this current market, this current environment, this current administration, I think that those types of companies could potentially be viewed as value traps. And maybe when we move past November elections and we roll into December, January of 25, maybe we can reevaluate the situations and potentially take positions in these apparel companies moving forward. But I really feel like these retail stocks and these apparel, these footwear companies, they've really been getting beaten up lately, and they're probably, in my opinion, going to continue to remain suppressed. Price to sales sitting here at 0.34 was basically, for the most part, higher than that. I'm not exactly sure I would use that as a main metric. Price to cash flow sitting at around 4. It was trading higher than that, but if cash flow is down, then your price to cash flow ratio will be down. Price to book sitting up here at 9 1/3. Now, usually, well, not usually, but historically, looking back several quarters, you can see they were in that double-digit mark and pulled all the way down to about 5.5 times book. Now we're up more than double that. We're up almost double that over the last couple of quarters. But again, these last couple of quarters, they've missed on the EPS and the revenue side, right? So this is what I mean. It's something when the stock is increasing, when the numbers are decreasing, now our ratios are increasing again, even though chances are, in my opinion, the stock's going to decrease. But okay. Enterprise value, again, technically what another company would pay to buy out this stock is technically valuing at about 150% higher than where the stock is currently trading. Our return percentages are down, the lowest they've been. Return on equity down, lowest it's been. Return on invested capital down, lowest it's been. Gross margin percentage down to sub 34%. That's the lowest it's been going back the last 7 or 8 quarters. Operating margin we looked at just went negative to about 5.25%. That's the first time it's been negative going back the last 6 or 7 quarters. EBITDA, earnings before interest, taxes, depreciation, amortization. EBITDA margin down here at 0.4%, as you see, was significantly better before this. And the net margin percentage we looked at went negative last quarter down here at minus 5.61%. That's the worst it's been going back the last 6 or 7 quarters. The inventory turnover was up here north of 4.5, dropped down, got back above 4, and has been slowly decreasing for the last 3 quarters, which again, they've missed earnings on the top and bottom line for the last 3 quarters. Asset turnover dropping as well. Again, basically how much money the company, how well they're able to generate revenue off of the assets on their balance sheet. And you can see the asset turnover has been consistently decreasing for the most part here quarter over quarter with these little pops, but then we immediately give it back. Now the asset turnover sitting at 1.39, used to be above 1.6. Our debt ratios are obviously climbing because the debt is up and essentially everything else, our assets, our equity, are down. Company does not pay a dividend. Let's look at earnings here, and you can literally see when it hit the fan, right? You can literally see it. Now, granted, the revenue has really been inconsistent in my opinion, but again, for some reason, we're keeping this stock up. But as of late, again, 3 quarters in a row missing on the EPS side. On the revenue side, the company has come in above expectations. Only one time on that main Q4 big quarter number, they beat revenue estimates one time in the last 6 quarters. They beat revenue one time in the last year and a half. They beat before that, obviously, but again, even looking at as a whole, they missed 5 of the last 8. They missed 5 of the last 6. In my opinion, this company seems very inconsistent, and we can see, again, we were talking about dropping down to that next level of the low 1.4 billion number, and you can see that after Q4, we expect to drop back below 1.4 billion, and then slightly above 1.4 billion, and then back to sub 1.3 billion. This would be Q3 of 24, these estimates 1.29 billion, and you can see we dropped to 1.27 just recently, and the quarter before, the year before, you can see we were above 1.3. So 1.32 to 1.27 to 1.29. But again, we're dealing with hyperinflation, right? Which means that, in my opinion, that translates to selling fewer items for more expensive price tags, right? So I would view that as a negative, not necessarily a positive, even though technically it's 20 million more. So in my opinion, I actually think the company keeps struggling. And even moving forward, you can see, look, year over year drops here in revenue, and then you're expecting a slight bump up to 6.2 and then 6.3, and then you're going to see supposedly a 5% jump in 2026. In my opinion, I see absolutely no urgency to buy this company, and especially if they're going to be playing the identity politics game and pissing off a lot of consumers, then chances are, like I said, it is probably only going to get worse before it gets better. Let's switch over here to stock charts. I didn't even want to speak that long about the company, but I just wanted to show you guys all the numbers and just how inconsistent it's been. And again, how they've been missing earnings consistently, it looks like, but the market is keeping them up for some reason. As we see here, we're looking on the daily, and we can see that the RSI sitting here at about 37 3/4, right? But not quite at that 30 benchmark level. So we could, of course, continue to sell off. That's why I'm saying if a miss does come in, we are going to, chances are, see a chunk down. I'm looking for about a 10-15% correction, in my opinion. And here on the daily, we can see that it just broke below the bottom Bollinger Band here, and our 200-day moving average is 21.45. We have a falling MACD. In my opinion, I think it adds to the accelerated sell-off, and I think we do see the low 20s, in my opinion. Switch over here to the weekly. We can see the RSI just dipped below 50. We're right here at this mid-Bollinger Band. Mid-Bollinger Band was 25.11. We can see stock right now 24.92, so we are below that mid-Bollinger Band. And you can see that even conservatively, if we have a drop here to the 50-day on the weekly, we're going to drop down to about 23.09. So we're still going to drop almost 2 points from where we are now. So that's what, at least 8 or 9% potentially. That's why I'm saying, in my opinion, 9-10% to potentially 15% immediate sell-off. We have the MACD was climbing. Now, of course, it's curling here as of late with these red weeks, and we could potentially cross to the downside, and that would obviously add to the momentum of the sell-off as well, which is why I'm saying also that if they do miss earnings, we could immediately see not only low 20s, but again, we could break and drop into the teens. 1830, bottom Bollinger Band on the weekly. Let me go back because I wanted to check the pivot points. And we can see on the daily, we had a support level here of 25.53. The stock basically just clean broke straight through that. And what do you know? Look at our next support level, 22.51. Looking back here, I said we fill this gap. As you see, what was the high? 22.57. It's amazing when it all lines up, isn't it? So that's where I feel in the immediate short term the stock will go. Let's check the weeklies. Yeah, off screen we can see it tried to hold this pivot point here of 29.13, but we can see recent rejections and breaks. And now, of course, we have a big drop here. And that's why, again, I feel low 20s, MACD crossing. In my opinion, Victoria's Secret today after the bell, VSCO puts, in my opinion, for the earnings play. And I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, we're volatile, and we're very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day.